planning of expansion on the international markets. We are going to open our first showroom in the US in this running quarter, and more international markets are also now considered, like UK, Canada, and Australia, etc. We have high franchisee inquiry also from those markets. We will surely get into those markets, but India will be the major share of revenue.
Ramesh, I'm wondering how your e-commerce business is doing with your Candere brand. Are you seeing traction pick up there?
Yeah, as we speak, it is not only an e-commerce segment. You know that we are opening physical showrooms. That vertical in India is really growing. Lightweight jewelry, Gen Z, working women, giftable. So that's really growing in India. And we are now targeting to open physical stores in Candere. We have opened we are at 46 showrooms now, and we will continue to expand the physical stores. And post we reach a comfortable number of stores, we start campaigning for the brand. And it is an omni-channel rather than only e-commerce now.
You know, Ramesh, one quick question I just want to understand, and I think this is a good sense that we will have from the industry, because what we usually see is gold prices move up, stocks like your company also run up. Little do we know what the connection and the correlation is. One thing I know that there has been higher inventory cost on back of the fluctuation in gold prices. How do you manage this, and does it have an impact on profitability? Does it sort of, disturb the equation that is there?
We don't take any gain or loss in inventory, except the customs duty, of course, which we cannot hedge. Otherwise, strong shift from unorganized to organized is what we see for the jewelry segment. That is why you might see the stock prices going for organized players, is what I think. And look at the revenue numbers, look at the SSGs for the past many quarters. And that is the reason more than the gold price. I don't think there's a connection between a gold price and the stock price movement.
We'll leave it at that, Ramesh. All the best for active next couple of quarters. Thanks for taking the time out and speaking to us today.
Thank you.
We'll touch base with Kalyan Jewellers, of course, post their Q3 numbers, first on NDTV Profit. But speaking of Kalyan, let's get in Mahima for a quick view that Citi's put out on Kalyan Jewellers. Mahima.
Right. So Citi has come out with a buy rating, and they've maintained buy since quite a few time now, and they've increased the target price to 810 from 770 previously. Now this poses an upside of around 21% from its yesterday's closing. What they're saying is that return on capital employed will improve to 28% by FY27, and they expect higher growth, ROC improvement, and re-rating of the stock on store expansion as well as deleveraging. Now profitability is expected to improve further, which will be led by a revised franchisee agreement, and they see a 25 basis points higher margin going forward as well. Lastly, they've changed FY25 to 27 EPS estimates by +2 to -6% for their valuation. So this is the overall view of what Citi is making of Kalyan Jewellers on the back of Q2 earnings.
Thanks, Mahima, for that. So that's the pre-open Kalyan Jewellers, of course, and that stock is starting off flat. The pre-open session is starting off flat too. Is the market giving scares, or is it an opportunity? Parag Thakkar, fund manager at Fort Capital, with us on the show. Parag, good morning. Thanks for joining in.
Thanks for having me on the show.
Constructive, deploying cash, or you believe there are more downsides ahead?
Deploying cash.
Why so?
So basically, simple I told you on the last show also that when we were at 26,000, definitely I was thinking that market was looking overstretched. And September numbers results were going to be bad for many companies. We knew that, right? Because it was a prolonged monsoon. Plus, after elections, the government spending was less. So we knew that September quarter results are going to disappoint markets, and Nifty was at 26,000. So we sold and we created cash, 20%, 25% cash. And now that, as you heard from Kalyan Jewellers, many things have started picking up on the ground. Okay, festive consumer durables, if you ask, jeweler you just interviewed, two-wheelers, for example, Royal Enfield, last month numbers were good. They are saying that this month after festive also, like Kalyan Jewellers, they also said that after festive the momentum is sustaining. Many things. So for example, I spoke to two cement companies in last 2 days. They are saying that government spending is coming back. right? And in the bottom of the cycle, remember, many companies do right things. For example, Remco Cement is one of the company where we are at the bottom of the cycle. There is a bloodbath in cement market, right? At this time, they are reducing debt by 1,000 crores by monetizing their unused land parcel. Right? So it's a very right thing to do. When you reduce debt at the bottom of the cycle, you become more competitive. You are adding capacity at $35 a ton, right? So when entire cycle turns, because how long industry can sustain this kind of profits where so many companies are bleeding, right? So at the bottom of the cycle, if you buy a good company which is taking right steps.
But are we at the bottom, Parag bhai? That's the question.
So I'm saying cement, I'm 80% probability that in next 1 or 2 quarters it will be bottoming out. And if you hear the Shree Cement call, they are also saying they are seeing green shoots in the market. And January, February, March seasonally is a strong season for cement in India, because that is where the government projects are getting executed.
Okay.
Right. So I'm saying that we are just nearing the end. This is not only true for cement, many other companies, I would say. So the situation has become like that because dollar index has gone up after Trump has come to 106.4, or say US 10-year is at above 4.4. So macros are looking very scary. FIs are selling, even retail HNIs are selling. And so now the situation is reverse of what it was in 26,000 Nifty. You know, that time the September quarter was looking bad, but still Nifty was rising. Now, because of the scary macros, we are at 23,500. And actually December and March quarters are looking better because government spending is going to come back and festive season has created some momentum. And because, as you rightly pointed out on the show, that November is the highest marriage season, right? So some of the consumption things will pick up in November. So it's a good situation where you have a contra buying opportunity in many stocks.
Okay. We are going to be talking about this contra buying opportunity with Parag and Shrikant Chauhan as well. We haven't had time to get his top idea, but maybe we'll do that post-market open, but because only 8 seconds left. But remember, watch out for the iShares of the world, which might do well, Nalco, which might do well, and a clutch of others on results, which might be reacting. But here come the first trades this Thursday morning. Flat as flat can be, but banks are doing okay. Wonder if it's oil and gas again the culprit, or is it IT? IT is flat too. So maybe it's oil and gas. So no, not doing the oil and gas. Actually, let's get the Nifty 50 heat map up on the screen. I'm very intrigued and very wanting to know what is correcting. Okay, not too much. Maybe an HUL. So FMCG, ITC, HUL, 2 pressure points on the index, Britannia. So it's FMCG which is not cracking really, but just dragging the index a little bit. But a lot of optimism, and the optimism is right there at the top right corner of the screen. Eicher Motors, 7% strong. Shouldn't surprise because the commentary was very, very solid. How many companies have you heard which have said that the post-festive demand was better than the festive demand itself? Then there is M&M, Tata Steel, Asian Paints. Yeah, a fair degree of green, very little red. The market is not doing too much. Clearly, the biggest takeaway of the morning, at least on the index, is Eicher Motors, 6.5%. Solid showing, solid con call, and a great price reaction.
What I'm noticing, Neeraj, is the distance between Eicher Motors and M&M right now in the kind of gains. That's giving you a sense of the underlying weakness of the market. So more green on the screen, but will it sustain? Because you see in the last few seconds, the Nifty has also come off. Let's pull up the sectoral indices just for a bit and give you a sense of what is working this morning. Small caps not doing too badly, frankly. Metals also coming back to some extent. So that's okay. On the weaker side, government-run companies, oil and gas, energy, maybe. But overall, market staying stable after a very, very tough couple of trading sessions. Let's pull up individual stocks as we move ahead, and a lot of it coming in from results impact, and you will see that on your screen, because even as the mid cap and small cap are stable, but individual stocks are the ones where all the action is. Good results, I should definitely on that list, but look at Godrej Industries. Godrej Industries actually pretty decent. And remember, this is a quarter where they had change of guard, a lot of things working out, very peaceful transition from previous generation to the new generation. Stock 5% up. Eicher, of course, a star of the day. Nalco about 3% up. But All of it about earnings impact. And let's get the next set up. Brigade Enterprises weak quarter. We're going to be speaking with the management in a bit. Stock about 2% down. We told you Vodafone you could see as glass half full or glass half empty. Clearly enough investors looking at both sides of that coin because that stock completely flat. In spite of some would say losses widening, but revenues going up. Kriti Engineering, strong numbers, 0.5% up. Apollo Tyres, actually, optically the numbers don't look that great, but stock is about 2% up this morning. Kalyan Jewellers, we just spoke to the management. They're saying the beginning of Q3 has been as good as Q2. Stock completely flat. Garden Reach, strong numbers. This company, the stock back in focus after quite some time, has been quiet, but 4% up on Garden Reach as well. Let's look at the indices overall. I would say they're doing better than the Nifty right now. The mid cap about 0.5% up and small cap actually doing better. So maybe some buying coming in this morning. So Samina, not all gloom and doom. Maybe me turning up has helped.
Now, Tamanna, it's so difficult to call this even for a few minutes, right? But yeah, it's not started off too badly, and I think that's what we are not feeling too bad about. It's not a material recovery. It's as flat can get. Broader markets are doing slightly better, but I don't see any reason for us to get very excited about that just yet. On the winning side, you've got Eicher Motors. That could be your stock to track, 6.5–7% higher, followed by Godrej Industries. Even though too many people don't track this company as it's a holding company, but of course looking really good, at least on the trading side this morning, up 5%. Redington is looking good. Motilal is having a good day. Nalco is up 4%. RCF numbers were very strong. I highlighted that for you at the start of the show. Up and about in trade, about 4% on RCF is what we have. Natco Pharma, Suzlon Energy, UTI, some of the other counters that are trading with a clear positive bias. On the sell side, PI Industries, weak numbers, stock is down 8%. Brigade is also getting a thumbs down, 2% low. Let's take a look at Apollo Tyres. Numbers were quite disappointing. It should be reacting to its earnings in early trade. Surprisingly, it's up 2.5%. Actually, I'm going to ask Parag about this. It's a tough quarter for the sector and for the company. The stock still looks good in early minutes of trade. A quick check on Thermax, Dilip Bilkon, Torrent Power. These were counters as well, the reported earnings. Thermax is up but marginally higher. Dilip Bilkon is up with a 1% gain, and Torrent Power, if we can quickly get that one up too to see what's happening on the stock. Numbers there weren't too great, and the stock is down 3% as we see it. The VIX continues to rise up about 1.5%. Nifty Financials is marginally higher. Banks, of course, holding above 50,000, and that is what most people would be heaving a sigh of relief for. But the Nifty is still sub 23,600 for now. Parag, you talked about how some sectors may have bottomed out. You mentioned how cement usually has it tough in the quarter that we've seen. Any other sector that you feel, or any other stock that you feel the worst is behind us? Stock price is pretty well priced, which means currently it becomes a good stock to add to one's portfolio or one sector.
Yeah. So first of all, see, I'll start with the fact that the starting point valuations were high. That was the one reason. Trump trade has begun. So dollar index and US 10-year bond yields are rising. So FIs have been selling. Right now, in this entire negative macro setup, I would like to highlight the positives, right? Positive. For example, if you see the results, or even I would highlight first in the large cap bucket and then in the mid cap and small cap bucket, the results which were good, which were completely ignored by the market because of FII selling, right? So first of all, let us come to large cap. Large cap, HDFC Bank did what it was required to do. They brought the CD ratio down by 5%. Their ROE is still sustaining at 1.7, 1.8%, correct? And their asset quality is best. Credit cost is 50 bips, right? 50 bips on a lower loan book growth, which is just 6% loan book growth, because they are forced to bring down their loan book growth because to bring their CD ratio down. Their deposit franchise continues to be strong. They did 1,20,000 crore of deposits this quarter. So that was a good quarter. ICICI Bank, fantastic results. PPOP growth of 15%, which completely beat the market estimates, because now they have a new shot in the arm, which is OPEX. Now OPEX to asset ratio for ICICI Bank is coming down. Right. So I think ICICI Bank continues to consistently surprise market on the positive side, and rightfully so. Now it is trading at a significant premium to other banks, and they are sustaining their ROA about 2.2%. SBI, such a large bank and a proxy to Indian economy, credit cost only 50 bips. What more you want, right?
No, the deposit growth guidance didn't bother you?
No, that's okay. In SBI, you have a CD ratio which is low. So in SBI, you are not required to grow deposits at a rate which you are growing advances or at a faster rate than your advances, right? SBI has a basically, see, I'll tell you, in the banking, the buzzword is asset quality now. Because you have seen the pockets of MFI and various stresses. So if these three large banks of India, HDFC, ICICI and SBI are showing you a credit cost of 50 bips, it's a big positive because at least they know their customers, they have lended to their known customers, right? And they have not given some unsecured MFI loans which will go bust. So it's a big positive and the valuations have become extremely attractive. The ROA divided by price to book, if you do, almost it is 1x. PG, if you see, the growth rates are 12 to 15%, PEs are below that, right? So that is one banking. I'll come to auto, Mahindra and Mahindra, excellent result, again beat market estimates. Tractor is 55% of the profits. Tractor has bottomed out. For example, last month, the estimates were 50,000 tractors. They sold 65,000 tractors, right? And tractor is a very high margin business for them. On November 26, they are going to launch 2 new SUVs, electric SUVs. Right. So auto launch cycle is also good. If you remove their net cash in the standalone balance sheet and subsidiary value, the cash flow yield is 6% on their EV of 2,50,000 crore, which is left after reducing this thing, right? I just spoke about Remco. That at 20,000 crore market cap, at the bottom cycle they are making 1,000 crore cash profit, which will only improve because the entire industry is bleeding. Sure. Government spending is back in last 2-3, I would say last 1 month. Okay, and they are now reducing debt by selling the unproductive land. Right now. So there are many. Emcure Pharma. Just to give you 2 more examples. Emcure Pharma, good decent company, negligible debt. Good promoters, 20% revenue growth, 38% EBITDA growth. So operating efficiency is shown here, right? And they are guiding for 15 to 20% growth. If you read the call, they have said that our only goal is to improve margins, which means their ROC will go up, right? Minda Corp, second example. 8% revenue growth, 26% PAT growth, 12% EBITDA growth.
You've got 7 solid companies.
Again operating efficiency.
This is amazing.
See, I think corporate India has realized everybody is looking to deleverage. The other thing which I want to bring down on because today
we have 30 seconds. 30 seconds for this.
Everybody is negative, right? What I trying to point out is where in the world you have a debt to GDP of 83%, where in the world you have a corporate India completely under leveraged. Banks are sitting on good amount of tier 1, strong balance sheet, and I would say the most strongest regulator. So there is no chance of any financial scams or anything going ahead because our regulator is so sharp. They spotted this MFI stress much earlier. They spotted this unsecured personal loan stress much earlier. So we are not a euphoric economy.
Got it.
We are a strong, solid, stable economy.
Got it. Thanks for these things, Parag. By the way, viewers, don't construe these as buy or sell recommendations.
Yeah, sure.
Please do your own due diligence. But very quickly, we have Mr. Jalan of RK Forgings joining us in a moment. But Shrikant Chauhan, take a moment with you. Quick, Shrikant, 60 seconds. We have a guest waiting. Opening thoughts and a view on PI Industries, which is down 9% because they've withdrawn their guidance.
Yeah, Neeraj, yes, it is down and it is like forming some lower top formation. It's like a distribution sort of formation that we can see. But at the same time, the stock has fallen drastically from the highs and now it is very close to 200-day simple moving average. And whenever it has fallen to 200-day simple moving average, we saw some buying interest in the stock. So I am of the view that if there is a long-term view, medium-term view, we should look for adding this stock at current levels instead of selling at these levels. It is better to stay away from taking any short positions. But yes, if there is any further more correction, look for adding this stock.
So much for that, Shrikant Chauhan there. On what the market is looking like, but even as we settle in for our next conversation, since we have Parag Bhai with us, you gave this superb list, and of course I don't think there's any buy recommendation or anything like that.
Yeah.
But
these are just observations.
And the filter was very clear. Companies that have given good results, but the market has ignored it. Now, having said that, what are the 3 or 4 kind of stocks that you are seeing that have come down enough where the valuations question no longer arises and strong enough. Let's remove just the corporate results filter.
So I am saying that, see, banking is where valuations have become extremely attractive in the case of HDFC, ICICI and SBI. So see, as an investor, you have to buy two things, right? Either you are at the bottom of the valuation or you are at the bottom of earnings. So my sectors are, in the bottom of the valuation, you have banks, HDFC, ICICI, SBI. And bottom of the earnings, you have cement, where I like various companies like Remco, Shree and Ambuja and all, where I feel that cycle is bottoming out. So these are the two lists, and of course Minda Corp and Emcure Pharma are out of these sectoral themes on a bottom-up basis. For example, yesterday I saw, and this is not the stock in my portfolio also, I just saw results. Lumax Auto reporting good numbers, Kirloskar Oil has reported good numbers, right? In auto, apart from M&M, of course,
would you look to adding these counters today? When
so some of the stocks we need to see find out the reason for how this so Federal Bank, again, it was on your list, so that's a very good number, very well managed bank, again no MFI stress, and now Mr. Manian coming in, he will give a strategy refresh in December. There will be a lot of excitement in that counter also.
Okay, we would love to ask you about RK Forgings at some point of time, but you want to hear this conversation because Mr. Naresh Jalan is with us today, Managing Director at Ramakrishna Forgings. And Mr. Jalan, thank you so much for waiting by patiently, but just that the markets are so choppy, it was important to get in our guest's view here, Parag Thakkar's view. But thank you for joining us today, and would love to understand, sir, are you sensing a sense of some bit of government spend coming back? Because a lot of people believe that that was what was ailing the economy, if you will, in addition to elections and monsoons. Do you believe some bit of it is back on track?
I think we are just seeing government spending starting, and I think that's the reason CV cycle is doing better. Festive seasons have gone good for commercial vehicle industry, better than previous months. So we are seeing that the front loading of the capex is happening.
Okay, and is this, I mean, you've seen various cycles, Mr. Jalan. Is this something that could be sustainable, or will you need to see more spend from the government on capex? Because, I mean, private sector is coming in very selectively, so maybe the heavy lifting still has to be done by the government. Are you seeing more signs of spend coming in from the government, and will that help all of the allied industries in which you are present in?
I think infrastructure growth in India is still at a very nascent stage. And I think infrastructure spending by the government with the budget estimates, we are yet to see, because of the election and all, first half, nothing as great has happened. I think in the next half, I think it will be a much better government spending. And this will kick in a lot of infra projects. And with that strong CV cycle, we are expecting to have that to happen. As well as I think private capex cycle also had started, but selectively. But I think with the capacity right now planned out, everybody will need to continue, be now on to add capacities.
Jalan, for the factors that you just mentioned and you and Neeraj spoke about, you have guided for a 15% revenue CAGR between FY24 to FY27. Keeping in mind the pickup in infrastructure spending as well, do you feel like there's a good possibility and a good chance that you would go back and revise the guidance upward?
No, we stick to our 15 to 20% growth guidance, I think. And basically, our revenue also is dependent on the commodities. And we are seeing soft commodity, which is also good for the automotive industry. But with the soft, I think the top line, we may have a softer top line. So we stick to the guidance of 15 to 20% growth.
Margins have dipped slightly to 22.1 from 22.3 that we had seen. Now, what led to this margin weakness in this quarter? And also looking ahead, as aluminum forging does ramp up, do you expect any margin impact from the initial setup cost or any other costs associated with the segment, which could then again put further pressure on margins?
Aluminum forging, I think, is going to start in the second quarter of FY26.
Okay, so it's still far out.
Yes, and I think that is going to be a game changer for RKFL. And we are starting with a very small capacity of only 3,000 tons annual capacity. And I think from there on, we are going to add up in this capacity. We have a vision in next 3 years to get to almost 20,000 tons per annum capacity in aluminum. But we'll be slow and steady with that. But that is going to be a game changer for RK.
Mr. Jalan, good morning. Tamanna here, and thank you so much for speaking with us. The volume growth for this quarter, of course, has been robust, and we've seen that pan out in EBITDA, revenues, etc. Do you see that sustaining? What is the kind of volume growth outlook you have for the full financial year?
We have a full, I think we'll be able to sustain that volume growth, and we should be doing better than what we have guided. I think we are looking at almost 15% plus volume growth. And I think we are sticking to that volume, and we are confident of achieving better numbers than what we have guided.
About a 15%, even better than 15% for the full year?
Yes.
Okay. In terms of, the kind of tie-up you've had recently, and I think this was very interesting, the JV with Titagarh and the LOA you have received. Can you give us some idea of when those revenues will come on board? What is the outlook on that JV?
So I think the plant is being set up in Chennai, and it's a greenfield project. And we are going to start rolling first set of wheels for Indian Railways, I think in December 2025. So we are well on track for last quarter of FY26 to start revenue with Indian Railways in wheel project.
Oh, lovely. So 2026, we see those revenues coming in. What is the quantum?
So we have a tie-up with Indian Railways for minimum offtake of 80,000 pieces per annum. And we are setting up a manufacturing capability of close to 200,000 wheels a year. So we are looking at almost by 2028 to get to full production.
Okay, and this segment, what would be its share in revenue? How do you see this growing, this tie-up with the Indian Railways? Do you see this as a business that will continue to grow?
We have a 25-year take-or-pay agreement with the Indian Railways. So I think for 25 years, we don't need to worry in terms of offtake from this plant. So till 2050, we have a confirmed order book of 80,000 wheel sets every year.
Mr. Jalan, I'm just trying to recollect and rack my brains. This from a 3,000 crore to 5,000 crore revenue run rate was the target till FY25, if I'm not wrong, right? Or was it FY26?
FY26.
FY26. So you seem to be well on track to not only beat that, but beat that, right? Your trailing 12 months is about 4,100 crores already. So you will probably do that much earlier.
Yes, we are going to do it much earlier.
Okay, so then would that therefore mean that you revise FY26 higher, or is the situation fluid right now because of how the global economy as well as the recent stress in the local economy?
No, I think with the kind of capacity we have added and kind of order book we have right now, and the new businesses which we have won, we are confident of beating that, and we are going to revise our guidance for FY26 on the upward side.
You will hike the FY26 guidance as well. Would you need to raise any capital, Mr. Jalan, in the ensuing period of the next 12 months to either do capex or any other reason?
No, I think we are done with our capital raise, and we don't need any further capital. I think the free cash flow of the company is well positioned to for all our brownfield and greenfield projects, which we have planned out over the next 24 months.
Mr. Jalan, like I said, we have Parag Thakkar of Fort Capital with us, and he wanted to ask you a question as well. Parag?
Yeah, hi sir. Thanks a lot for taking my question. So basically, we are here, and I think you answered this question to Neeraj, but that time I was not able to hear. So many cement companies are pointing at that from last 1 month or two, or say last 20 days, the government spending has started to pick up. And as very rightly Neeraj pointed out, that was the main worry, and that is the main drag on earnings as of now. So I would like to know your more detailed view on that government spending is back?
Yes, I think, like I said, government spending is back, and we always were aware. And this happens every 5 years. During election time, I think government spending slows down. And I think from September onwards itself, we are seeing government spending pick up. And I think that's going to continue. And I think with 5 months of no spending, I think we should see like next 7 months, the entire budget or most of the budget spending should happen. So it should be much better than what we have seen. And that's the reason you will see pickup in infra spending, which will cater to a lot of other segments getting boosted with that.
Absolutely. Great to hear that, sir. So I think Jan, Feb, March should be a good quarter to watch, right? In terms of India domestic cyclical earning space, right?
I think October, November, December also should be much better than what PA market is expecting.
So just one quick question, and I want to get a sense of what's happening. Of course, we've spent quite a bit of time talking about the domestic setup, and we also got Parag Thakkar to ask you that. But you know, you've got an order book of about 1,520 crores, primarily from the overseas market. You want to give us a sense of what the contribution of the overseas market is, what strategies there are in place, and how do you see that play out? Because with all the focus on domestic, but still a significant order book from outside is commendable.
I think we are well positioned for 50% of our volumes from exports. And I think this order book reinstates our commitment to continue to grow in geographies across the globe. And Europe primarily is a focus area wherein we had a very less contribution. And most of the order wins now are coming from the Europe market and off-highway segment from the North America, which also deleverages our balance sheet from only automotive to non-automotive. Our overall target actually for automotive, non-automotive business is 60% automotive and 40% coming from non-automotive. I think we are well on track by FY27 to achieve that target.
Okay. Well, Mr. Jalan, this was such a pleasure talking to you, and it was lovely to understand those words from you, that October, November, December could be much better for India Inc. than what the street is penciling right now. That's a key takeaway. And wishing you the same for Ramakrishna Forgings as well. And look forward to the revision of the targets as and when you hit 5,000 crores. Thanks for speaking to us today.
Thank you. Thank you. Thank you very much.
Thanks.
That's Naresh Jalan. Parag, quick 20-second answer because we have Brigade Enterprises waiting. Are you happy with what Ramakrishna Forgings has said?
Absolutely.
Is forging a good sector to bet on?
So I'm saying anything which is domestic cyclical, whether it is banks, whether it is cement, whether it is auto, and you know, say the Eicher Motors also told, right, that the momentum is continuing after festive.
Sure. Okay.
I'm sure in some categories it might slow down, but I'm saying November again is the highest marriage season. So some earning momentum is coming in while Nifty has corrected 10%.
Got it.
When we were at 10% higher, that quarter was looking bad, and now we are 10% lower and earnings are looking better. So I would say that is a strong case to deploy money right now.
This is going to be your new consulting job. You're going to come in and ask questions to all these
but I'm serious because we're speaking to Brigade next, and again, real estate sector, very, very important. So we're going to request you to stay on with us because that insight is amazing. Just a take from you on Brigade as well after we finish this conversation. But we have with us Nirupal Shankar, Joint Managing Director at Brigade Enterprises, talking about the quarter. Ms. Shankar, thank you so much for speaking with us. Always a pleasure to have you here with us on NDTV Profit. Let's start. It seems like a bit of a tough quarter because we've seen sales volumes coming down. Are you seeing stress in the residential segment, which is your largest segment?
Yeah, good morning. Thank you so much for having me. It's always a pleasure to be here as well on NDTV. See, this quarter, if you compare it with the previous quarter, we've actually had a 46% increase in our overall sales. We're at 1,821 crores now. And even our collections has been at 1,900 plus crores, which is again a 35% increase over the same time last year. Of course, there's been some slight delay with the launches of new projects, but nevertheless, we've managed to have a pre-sales volume of about 1.68 million square feet. And the good thing is that despite the fact that, you know, some of our launches are slightly delayed due to some slowness in approvals, we've been able to capitalize on the cost. Our average realization has also increased by almost 45% from the same time last year. And so overall, we are fairly bullish, and generally the second half of the year is definitely...
No, absolutely, agreed. But having said that, in all of H1, your sales volumes are down 10%. You have seen a drop in revenues of 22% this quarter. So just trying to understand, Nirupa, where that pressure is coming from. Is this because of launch delays? Or are you seeing demand peter off in the last quarter and maybe it will pick up in the second half?
Oh, I think demand is fairly strong. I just think it's a matter of us, not launching projects soon enough. And main reason for that is there's been a bit of slowness in getting projects approved. So anyway, we are fairly still bullish about the coming next 2 quarters. And as long as we're able to launch, I think the coming year will be very good.
Nirupa, a couple of other things that have stood out. Your margins have actually expanded quite well, and you alluded to that a few minutes ago. Is this margin expansion, one, sustainable in the second half of the year, or would it improve further, which would be a good thing? And also, okay, maybe you answer this and we talk about the leasing revenue, because that's actually seen a good uptick. So just a quick word on margins, and where do you see that play out?
So margins have been good for multiple reasons. One is because we have launched some very premium projects, especially in Chennai. We've launched Brigade Icon, where the average price per square foot is around 30,000 rupees per square foot. We've re-entered the premium market in a fairly big way, where ticket sizes above 3 crores, 4 crores, and those units also have an average price per square foot of 12,000, 13,000 square feet. So there are multiple reasons for the increased realization, which also leads to the increased margin. One is the segment which we have launched our projects in, and the second is, of course, like I said, there is still strong demand. We're able to increase our prices while keeping the demand intact, and we're also able to reduce the sales cycle. So previously, I would say prior to COVID, we would sort of spread out the sales cycle over the development of the project. But now we're able to sell the project within a shortened period of time while it's still under development as well. So there are two factors. You're able to increase prices while demand also remains strong. And like I said, average realization has gone up because of the nature of the prices.
Quickly, leasing revenue was up 27%, occupancy rate stands at 97%. Are you working to increase that part of the portfolio? Because that looks far more healthy than what we've seen in the recent past. And if yes, then where does it take us?
So Brigade has always maintained that we like to keep, a good balance between our residential portfolio, leasing and hotel portfolio. So typically, the residential portfolio can account for about 60 to 65% of our top line, and then the leasing portfolio can account for generally 25 to 30% of the top line, and hospitality also about 10%. So it varies slightly between which cycle we're in. The leasing revenue, you'll always see a better uptick when a project is completed, and during the 3 years or so while it's getting constructed, while we're spending money on the project, you're not really seeing any increase in rentals. So here we've completed some of our large projects, and we're starting to see the rentals come in, because even once you finish a project, we have to wait for at least 6 to 8 months till clients come in, do their fit outs, until we see revenue. Now we're finally seeing some revenue come in. The leasing revenue includes our retail portfolio, some facility management business, as well as our office rentals. And, it is a good time. I know office has been getting a lot of skepticism in the last few years as to where is it going to go. But I must say that I think India will hit about 70 million square feet of leased transaction space in calendar year 2024, and out of that, Bangalore should get about 16 million of that, which is the highest that Bangalore would have ever seen. So I would say that leasing is pretty strong. There is demand for major cities. Bangalore, of course, Mumbai are all seeing demand for office space right now, and I think Hyderabad as well.
Nirupa, good morning. Neeraj here. I just have one question really. Because you are at the end of the first half, and you can maybe look out maybe 18 months out, and because quarterly numbers become difficult to track because of pre-sales versus delivery, etc. From what you were in FY24, annuity business and residential sales, what do you reckon you might be at, let's say FY26, 27, what have you, considering that the internals are looking so strong?
You mean in terms of top line, or in terms of
or volume growth volumes, growth factors, what have you?
See, of course, we have to go with where the market is, but typically what again, I can't give too much of forward-looking guidance, but typically we say, 15 to 20% growth is kind of what we look at. And, if we do better, that's a bonus, but that's the minimum that we would want to achieve year on year.
Just one very quick one, Nirupa. You've managed to reduce your debt quite significantly by about 2,656 crores to down to about 850. Now, a very healthy net debt equity ratio. With the new projects that are coming up, how do you plan to finance them? Is it going to be through net debt, or do you plan to continue to maintain low leverage? And then, of course, look for partnerships and equity.
So, see, we've already finished our QIP recently, so we've managed to raise some equity there. But with regards to the debt, I would say that our residential business, because of the healthy cash flows that it has, we are pretty much zero debt for our residential business. Most of the debt that we have is also securitized. I would say 81% of all the debt that we have is securitized. The balance is for ongoing projects and for construction finance. All our future projects, especially the capital expenditure heavy ones, will require some construction finance, so that we will get project to project. We managed to keep our cost of finance also fairly healthy. And it'll be a combination of accruals and debt for future growth.
Nirupa, if we may, we have Parag Thakkar with us, and he's been tracking, of course, the space very closely, and he wanted to ask you a question, if that's all right.
Yeah, of course.
Yes.
Yeah, hi Nirupa. Thanks a lot for taking my question. In fact, Brigade was one of the largest holding when I was in ICICI Pru. So
that's nice to hear.
We have a huge respect for your company.
Thank you so much.
Just one question, that you said that approvals were getting delayed, right? Now that approval cycle has revived, because now that election has already happened, and now we are 6 months after the election, the approval cycle has started to revive, because that will actually determine your sales and revenues and etc., right?
Yeah, I think it's getting better, but there's some slowness that sometimes is out of our control. But I think we should be able to launch about 16 million square feet within the next 4 quarters. So that we'll see a very healthy performance once we're able to launch, because a lot of the projects that we have waiting in the pipeline, we already have certain expressions of interest. So we know that there'll be very healthy demand for the projects as soon as we launch them. And the idea is to incorporate a healthy price rate, so start at a good average price realization, so that in case the demand is very strong, we're able to sell out those projects as quickly as we can. So we are expecting to launch about 16 million square feet in the next 4 quarters.
Thanks.
All right. Thank you so much, Nirupa, for coming and speaking with us and answering all our questions. Look forward to what Brigade is doing. And of course, the rise of the real estate market in southern India is also a very interesting story. Brigade stock has actually recovered a fair bit from its lows of the day. It's about 0.5% down now. And clarity coming in from the management that the concerns were approval delays because of the election cycle. That is set to improve. But with that, thank you so much, Parag Thakkar, for joining us today. Pleasure having you in the studio. We have to do this more often.
Sure.
But let's shift focus to an interview my colleague Sajid has done. He's spoken with Chairman and MD of NTPC, Gurdeep Singh, and Director of Finance, Jayakumar Srinivasan, and began by asking about NTPC Group's capacity addition plans.
Today we have 76 gigawatt of the total capacity. Out of that, around 62 is based on the coal, and around 6.5 gigawatt based on the gas based. Another 3.8, 3.7 is on the hydro, and this again. So, as far as the coal is concerned, there is no gas-based plant which is under construction, but the coal-based plants which are under construction, either we have awarded the contract or we are going to award, well, it's kind of already in the developed stage, around 26 gigawatt. So we should, by 2032, we should be around 88 gigawatt of this coal capacity. This is, of course, NTPC and joint ventures put together. It's the combination of that. As far as the renewable is concerned, that's what we have said is 60 gigawatt by 2032. But along with the storage, I believe that by 2030 we should be able to achieve that. We will not, and by 2032 we may be exceeding towards another 10 to 20 gigawatt. Maybe then we can reach around, let's say around 70 to 80 gigawatt by that time. We have very aggressive plans for that. We are working on that, and we are very thankful to some of the states who are coming forward for this. Andhra, just I mentioned, and Rajasthan, we have already 25 gigawatt of the firm capacity, which we have started working on that. Gujarat, we are working on Khavda and others, which is going to be around. We have our own renewable energy park, which is around 5 gigawatt. But in addition to that, we are also taking up some other projects in the other parts of the that Khavda park, which is totaling to around 7 gigawatt at that location. So put together, I think this is going to be.
And nuclear?
Oh, nuclear is just beginning. I think by 2032, what we are planning is only around 2 gigawatt. But at the same
This
time,
will be the modular nuclear plants.
No. This is to start with. It is going to be the concerned PSWR. But I think then this. After this, we are also working we are discussing with BARC and DAE how to participate in the small modular reactors. So this is probably at some other day we will discuss, because this is a full subject itself. This is very capital intensive. It's very technological, and more than that, I think there is going to be a lot of regulations, etc., which need to be taken care of.
Mr. Srinivasan, a big capex plan has been laid out by the chairman here. Do you think capital will not be an issue going forward?
Capital should not be an issue at all, absolutely, because we have multiple strategies to do that. One is NGL, as I was mentioning to you, is a self-revenue generating model. And of course, NTPC as a parent is there to back up with a large cash flows available. And sparingly, if it comes to some point that we are ramping up our capacity, depending on all the storage solutions coming up, green molecular business. We have the option of putting the money from NTPC also through a right issue. So,
and that time the right issue will come to all the shareholders as well, in that sense. Give me a sense of your margin, because I was looking at your margins, including the SPV for last few years, and how margins have contracted a little bit to 88% odd from 90 odd % which used to be in FY23. What is the profile of the margins for the green business, NTPC Green Energy business?
NTPC Green, your EBITDA margin is going to be around 86%, and 86 to 90% it would remain. It's a competitive thing compared to your earlier regime of cost plus. Definitely the pressure will be on the margins. But our strategy would be to not only participate in the tariff-based competitive bidding, we also have the model for your joint ventures with other PSUs, where the offtake has a color of a agreed cost plus arrangement.
Okay.
So this will ensure that we maintain our margins.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Long Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize.
Thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah, and Niva Bupa to be listed in moments from now. The management getting ready to ring the bell. It's a big moment in the life of any company which is doing this, and therefore this should be no different for Niva Bupa as well. But the interesting piece is, what premium does it list at? So in line with what was estimated, really, if you will, and in line with the discount price, obviously. So 7.5%. Let's see if this one has the same fate as Swiggy did yesterday, when it bounced back in the second half of trade to move higher. It is now starting to inch up, Niva Bupa, about 9% higher. Let's see how this one does during the course of the day. We'll, of course, keep you updated. But just take a moment to mark Swiggy as well, because yesterday was a decent outing for Swiggy, really. From the lows of the day, did really well to end. For now, about 2.5% lower. Not all new listings have had a good run. Some certainly have had, but Niva Bupa for 10% higher for the time being. Thermax is a stock in focus now. Let's talk about not the primary markets, but the secondary markets. And the numbers, revenues, margins, and net profits, all of them beat estimates. The order booking was higher. Large orders in the infra energy segment, and margins were higher on account of better performance in the industrial products category. Let's get in Ashish Bhandari, Managing Director and CEO Thermax, who joins us right now on the show. Ashish, it's been a really long time, but good talking to you. This is Neeraj here. I hope all is well.
Neeraj, all is well, and thank you for having me on the show.
Yeah, it certainly looks like Q2 turned out to be a lot better than what the street was working with. Did you pencil this in, or has it turned out to be slightly better as the turn of events happened?
I would want to take 2 points out. One, on the order side, when we started this year, we had talked about how this year we do expect some bigger orders to start coming back, because all of last year we were working with work that was going on, but we really didn't see too many big orders coming in. This year, that trend should reverse, and Q2 is a good example of that. Even as we look at the next 3-4 quarters, we have got other bigger opportunities also in play. If I take that big opportunity out, we have been growing steadily in a lot of the rest of our business. Industrial products has been growing double digit now for multiple years, and we see that trend continuing at least in the near future as well. On the margin side, there was one exceptional item in Q2, which was not unexpected. This relates to a PSI, a production-linked benefit that we got from the Maharashtra government, which is a scheme that one of our new plants was part of for some time. But now that the assurance of the benefit coming through is certain, we started to show this. This will continue in smaller amounts for a period of time, but this was a one-time, relatively bigger number that we showed in Q2. If I take this number out, actually our profitability was slightly below what we would have expected, and that is driven by continued challenges that we have on the execution front on bigger projects.
Okay. Can I, before I get into internals, Ashish, and some of these is really good to know, is this being led by global orders per se, or is domestic order flow looking good? The reason I ask this is because every single company that I've spoken to has said that because of government spending not being up to the mark, things are looking iffy or have looked iffy in the first half, and they'll improve once government spend comes back.
I would be in that similar bucket. The Indian spending is, and we are not directly driven by government spending, but we are driven in some ways by push through of government policies as such. And in that sense, the India numbers have been flatter in a way than international. International, after quite a bit of relative lull in the first 2 quarters of this year, has outperformed our India business. And even in Q2, the big order that we got was actually from an international project. If I look at India, we are not dependent, as I said, on government infrastructure specifically, but the one big segment where growth has been relative to last year, particularly muted, is in what is called as the 1G, the ethanol industry, which is derived from government policies and marketing agreements that the government hands out for a lot of what is called as this blending program for ethanol. Yeah, which is the projects are set up by various different players in the sugar industry and distilleries, etc. Many of those projects are on the anvil. Handshake has happened, but the financial closure and their agreements with the government oil marketing companies, etc., have been delayed. So I do see some amount of flattening on the India numbers, but when I talk to customers, I see a lot of positivity and optimism. So I expect the second half to be better. But so far, I'm in the same bucket that you talked. Many others are looking at.
So you may not be connected, Ashish, but some of your clients might be. So I'm just trying to understand, are you sensing some uptick in government spend? I mean, we were talking to a forging company which said that some of that has happened. Couple of cement companies mentioned that some of that is starting to happen. Do you sense that or not as yet?
Not as yet directly, but I'm not seeing particular scenes of any major slowdown or anything. Our distributors, our channel networks, every time I speak with them, they are still bullish on the outlook. They say their customers are looking to spend. And so I'm seeing reasonable amounts. Yeah, I'm just saying there's a flattening relative to what we have been going through for the last couple of years. And even there, most customers, as I speak with, indicate that the second half should be better. I'll caveat that by saying that, yes, I agree, the first half has been flatter on the India front, clearly.
So let's assume that India front also improves and some of the other things also go as per plan. How do you foresee the second half for yourself, both on order inflow and revenues, and two, also on profitability? Because I'm guessing it's a very volatile environment to manage cost pressures.
No, I think on the revenue front, lot more confidence given our backlog, and the backlog will liquidate itself at a reasonable pace. There's some amount of slowdown, as I said, relating to project execution that affects profitability to a little extent, but that should be manageable for a company of our size. Overall, from a profitability perspective as well, we are in a fortunate environment, in my opinion, where commodity prices have been stable. There's some amount of inflation on the labor end, but in general, steel prices and variety of other commodity prices have been stable. Yeah, despite the war and everything, oil prices, etc., haven't really gone up. So I wouldn't blame the environment at all. The project delays and the execution challenges are more related to labor, construction challenges. We have had climate-related issues on multiple fronts where rains, etc., have delayed things significantly. And other than our chemicals business, which is dependent on exports and some of the impact of freight, etc., which showed up in Q2. But even that, I think now that we have taken whatever was the impact in Q2, Q3 onwards should start to look better. So I don't think on the profitability side we can blame the environment. It is Thermax's own execution and how we operate that. I think that would be the question.
You've done very well in quarter two, right? As I was looking, the highest operational metrics at least since September 2021. Do you reckon this can continue? Is this a sign of things to come?
Look, I don't think, to me, the Q2 was a okay quarter, wasn't an exceptional quarter. And the reason is that
on the margins,
sorry, go ahead.
Sorry. I meant on the margins. I mean, it was...
I meant on the margins, yeah, because we had that one-time PSI impact that we had, which was 60 odd crores. Last year also we had a 12 crore positive. But even if I take that net of the two and say, look, we had a 50 crore good guy this quarter. If I take that 50 crore good guy out, the numbers were below my personal expectations. Yeah, and the place where we underperformed was first primarily on large projects and large government projects, which we are going through on the execution front. And second, little bit on our chemicals business. On the chemicals business was driven, as I said, by some of our export-related issues relating to freight. That we will recover in Q3 and Q4. Executing large projects better continues to be one of the things Thermax has to do better on.
Okay. Just very quickly, Ashish. So you sounding very confident about a strong second half. Was there a formal guidance given, and do you think you will beat that?
No, we haven't given a formal guidance, and I don't want to come across as bullish on the second half. I think on revenues and general profitability, I think we will continue to improve year on year. I think that's largely driven by a backlog. On orders, I would be in the wait and watch category because especially on the India side, we have seen, as I said, some flattening. It's not a dip by any means, but some flattening of the growth. And I would like to see that come back in Q3 and Q4, which means that the order inquiry that we have, we would like to see those translate into orders, customers paying advances, LCs being opened, so that you can formally get started on that.
Okay. Ashish, maybe what we'll do is, while we have to wrap up right now, maybe if time permits you, we'll talk closer to the end of the calendar to try and gauge how is the scene shaped up. It will be really informative at that point of time.
I think that would be a discussion I look forward to as well.
Great.
Thank you.
Thank you so much, Ashish. And congratulations on a good quarter. All the best for the quarters ahead. That's Thermax. Again, in his words, not sounding overly bullish, but certainly sounding confident in tonality and in terms of the numbers. Now, the stock is doing well. We shift focus back to Niva Bupa. My colleague Shubhana talked to the MD and CEO, Krishnan Ramachandran. And here's what he had to say on the company's prospects ahead.
Insurance is a long-term business, and our parent shareholder Bupa has been around for 80 years. So timing, to be honest, really doesn't matter. What matters is we're solving for the capital structure of the company, we're solving for permanency, and we are a long-term player, so I'm not worried about timing.
Okay.
Sir, wanted your glide path towards profitability. You have a lower market share as compared to your peer Star Health Insurance, and they have had they have a larger market share and a consistent performance in terms of profitability. So what is your glide path towards that going forward, given that there was a drag in the latest earnings? What's your view on that?
Sure. No, I think 2 points. We have been in significant investment mode in the last 4 years. That has meant that we've been growing a lot faster than any of our peers. Our growth CAGR in the last 4 years has been 41% plus. Having said that, when you look at our profit last year and the year before, we have been profitable, both on an Indian GAAP and IFRS basis. For Q1, because of the way our accounting works and the seasonality of our business, on an Indian GAAP basis, we had a small loss. Improvement over last year, but the right way to look at our financials is on an IFRS basis, which smoothens out some of these earnings fluctuations. And on that basis, we are profitable, so very much on a profit trajectory, Sohana.
Okay. And so, what about combined ratios? You're raising funds, to meet your long-term objectives, funding objectives, but also, you said that you want to improve your combined ratio, which is slightly lower than the industry average, and which is also impacting your expense ratio. So, how do you plan to take that forward?
Sure. Look, our combined ratio is sub 100 as of last year, sub 100 the year before as well. And when you look at industry, if you include non-life companies, we are one of the few players which have a sub 100 combined ratio. In terms of your question on expense ratio, the reason is because we've been in investment mode. We've grown in employee strength, close to 9,000 employees. We have increased our number of offices, our distribution partners, launched a number of products, technology investments. So for all of those reasons, our expense ratio has been heightened. Of course, it shows up in our above industry growth number. But we are now, as of last financial, we were 5,600 plus crores. So we are gaining scale, and as we gain scale, our expense ratios will come down, and we are confident that we will comply with IRDA's requirement of being 35% plus allowances for a standalone player by FY26.
Any number that you can help us with in terms of combined ratio for the current financial year? Because you have, as compared to other peers, ICICI Lombard, HDFC Ergo, they have a larger chain of network and, hospital chains. So as compared to that, how do you plan to improve? And, the number, if you could help us provide one.
So our combined ratio would be lower, than most general insurance companies. Last year, our combined ratio was 98% odd, and the objective is clearly to improve on that as we move along.
Okay. Yeah. So retail health has been the major focus for the company.
That's correct.
I wanted to understand if you could help us with the split of retail health insurance as compared to group, and going forward, if you would plan to diversify more this split of yours, and if you would going forward, where do you see this split going? Because the DRHP said that you're also planning to tap the SME space for this.
No, look, in terms of our split as of last financial, retail was about 70% and the balance was group. We are focused on retail because we believe it is a very attractive opportunity. It has lifetime value. It is difficult to execute. It is a talent and execution intensive business. So doing retail well means that you have some inherent moats, to use that language. In moving forward, look, we want to make sure that we grow our business with opportunities that are sustainable across the board. We believe our proportion will broadly stay the same, but on group, if the pricing environment improves, we are certainly very, very happy to participate in more of that business. Yes, our focus there is small and medium enterprises. But we're certainly very happy to look at additional opportunities, depending on the pricing environment.
And so on the distribution network, your online sales have been, slightly lower, and while there are individual agents and, marketing firms that is contributing to, as a percentage of your overall gross-written premium. But bank assurance is also lower as compared to those networks. Do you plan to increase, reliance on bank assurance? Are there any partnerships in the pipeline that we can see in the coming financial year?
No, see, look, our channel mix, if you look at it, I want to make 2 points. One is we are clearly multi-channel by strategy. So if you look at our proportion of various channels, we have a very balanced mix, and that is the result of a conscious choice. We do believe that being multi-channel and diversified, helps us over time. To your question on direct-to-consumer, look, it is a very exciting channel. It is a very fast-growing channel. And we would have one of the highest proportions of this business, relative to most companies operating in this space. So a good proportion, yes, it is smaller than other channels, but a good proportion of our business relative to anyone else is what I would say. As far as banks is concerned, again, see, we calibrate for us, a channel is a vehicle and an engine to acquire and serve customers. So as much as we can do across channels, subject to investments, subject to our ability to execute, we want to grow all channels, in a sustainable way.
Are there any partnerships in the pipeline?
None that I can speak of, but we do have 21 plus bank partners. We continue to add bank partners at a healthy clip. As I said, it's an engine for us to grow. Right. We want to have as many engines as possible.
Well, that's Niva and what they had to say. Bring up the stock again, just to mark that it's no longer 10% higher, just about 3%. So a fairly flattish morning. Let's see what it does during the course of the day. Just want to mark a few stocks. By the way, Diffusion Engineers was under a lot of pressure yesterday, down about 4% yet again today. It's a new listing, but which is seeing some serious pressure. On the other hand, KRN Heat Exchangers is up 6.5% today at 661. So seeing some serious upticks. So, well, chalk and cheese really for some new kids. Swiggy is flat. Wonder if Zomato is flattened out as well in the session today. Swiggy is recovered, as was the case yesterday, but flat. Zomato up 4%. From the time that the Swiggy IPO started, I think Zomato has given some decent returns as well. So not bad going for both of those. And very soon, Zomato will be a part of the FNO universe. So there will be trades that will happen there too. But the stock of the morning has to be Eicher Motors. Bring that stock up, independent of whether it's up 7% or 8% or low. But the commentary was quite astounding. And Puneet Johnson, to talk about that, the results, but also the commentary. And Puneet, take it away, because the con call had some seriously different mentions relative to what we have heard in the past.
Well, definitely. I think they've just flipped the table upside down this time. Results, as you rightly said, 3% revenue growth, 8% growth in profits. But more so, the commentary is what driving the stock today. There's a clear change in strategy for the company. Growth is the focus now in terms of sales growth is what the company is alluding to. And that's different from the previous strategy of maintaining EBITDA margins of about 25 to 27% in that range. Now, with the higher sales growth, the absolute EBITDA will increase. The margins might stay in this 25-26% range, but the absolute EBITDA increasing is what's enthusing the streets. Apart from that, the company's focus on, maintaining inventory at a lower level has also helped, because they are not like flooding the inventory. So inventory is just about 2 to 3 weeks, which also indicates very strong sales. They sold about 1 lakh units in the month of October. They're expected to have a better performance or at least a similar performance in November and December based on the marriage season as well. Apart from that, brokerages had really good points to highlight. Jefferies, they maintained a buy 5,500 rupees per share. And one of the major lines is that the toughest phase of the competition is over in terms of premiumization with all the launches of the competitors. And they've said the stock is now at a 15% premium versus someone like a Bajaj versus 60% that it used to be over the last 8 years. So the valuations have definitely been somewhat similar, while the others have also increased. Nomura has upgraded it to a neutral from a reduce earlier. They have a target price of 4391. And one of the major things they highlighted was the new strategy addresses one of the key concerns of lower volume growth. So that's why the upgrade coming in from them. And just finally on MK, they have upgraded to a buy from a sell rating earlier. Target price of 5,300 now for MK versus 3,750 earlier. So it's a double upgrade of sorts from MK. One of the major things is, of course, the new strategy that they talk about, but they've also mentioned that they believe the near-term margin pressure would be addressed once operating leverage kicks in. So overall, it's a big thumbs up on Eicher Motor from brokerages, management, of course, very enthusiast, and now, of course, from the investors as well.
Okay. Thanks for that, Puneet. 8% higher and going strong for Eicher Motors. Let's wait and watch. As Puneet said, some of the brokerages have given large upgrades, including MK, which is a double upgrade of sorts. Another stock in focus is Nalco. Can we pull that stock up? Because it was doing really well when it started off, still about a couple of percentage points higher. Mihika Johnson, to put those numbers into perspective, Mihika, is it some one-offs or effectively quarterly aspects which help the numbers and the margins, and will they change in Q3? Because the reaction is relative to the numbers fairly muted.
When you talk about what drove it, it was aluminium pricing. It was better aluminium pricing during the quarter on an average basis. And when we spoke to experts, it's a little hard to see how Q3 prices will pan out. The China stimulus does take into place, but when you talk about National Aluminium's Q2 numbers, revenues were up 31%. EBITDA saw a 290% uptick. Margin expansion that stands out, 2,567 basis points at 38.7% this quarter versus 13% a year ago, and net profit is up 458% to just about 1,000 crores. Now, when you talk about what led to revenue growth, higher aluminium prices, like I said, the aluminium EBIT was up 4.2 times year on year to over 8,563 rupees versus just over 2,000 crores a year ago. Margins were also aided by the cost optimization efforts. We had raw material expenses go down 32%, power and fuel costs go down 22% during the quarter on an annual basis, and the company has noted a positive domestic business environment in terms of demand. And when you look at the cumulative domestic sales numbers also for H for the first half of FY25, it stands at 2.21 lakh MT. We also had Motilal Oswal. It's maintained its neutral rating on the company, but it's raised the target to 420 rupees. Q2 results were broadly a beat on their estimates because of the favorable pricing, and they've raised the FY25 revenue, EBITDA as well as net profit estimates by 9%, 27% and 32%. And even when you talk about the second half of FY25, the outlook is positive. They expect EBITDA and net profit to grow between 24 to 30% on a year-on-year basis. So the expectations going in the second half of FY25 is also positive. Nalco actually recently entered an exploration and lithium mining deal, and this could also help diversify its product portfolio and enhance its supply chain, giving more terms of benefits from the cost side. But however, when you talk about the next growth phase, well, as per Motilal Oswal, the next growth phase will only come once the 1 million ton alumina refinery capacity gets added and comes on stream, which will happen by May of 2025.
Okay. So must say relatively muted, like I said, for this one in the session. Thanks, Mihika, for that. I'll tell you what's catapulted Eicher to become the top gainer on the Nifty 500. That's DCM Shriram, up about 8.5% today. Geo Financial and Network 18 are doing well, but Suzlon is the other big one because it's really shot up in trade today, 5% higher after cracking for the last many days. Suzlon was at 54 after clocking in highs of 86, and this is a sector which has got some very strong revenue tailwinds to itself. So steep correction coming back. A lot of the FNO entrants are doing well. Angel One is up 4%. Paytm is up about 4.5%. We already marked Zomato, and I think which is why Geo Financial is up about 5% as well. Everything coming into the this FNO universe seems to be doing okay. Deepak Nitrite after a okay quarter is up about 4% as well. So that's not doing too badly. I think capital market stocks by and large seem to be bouncing back. So watch out for a Nuvama, CDSL, Motilal Oswal, UTI AMC. Some of these are having a good day in trade. But with that, it's a wrap on this leg of Talking Point. Excuse me. Thanks so much for tuning in. and the F&O show takes forward the action on the other side.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome. You're watching the F&O show. The next half an hour we'll take you through a very volatile market, but I think we can breathe a sigh of relief. It doesn't look like there's a material recovery, but it feels like maybe we found a little bit of a floor for now.
Look,
or for today.
Even if it is momentary.
For today?
Yeah, even if it's momentary, I'm sure traders and investors will take this as with both hands. Even a day like this where you're actually not seeing significant gains, after the kind of fall that we've seen in the past few days, it's certainly going to be something that's going to give you a breather.
Yeah, and the breadth of the market is not great. Like we said, it's a 50-50 split. Nifty 500 is doing slightly better. Broader markets as well, not declining or falling off the cliff anymore. In terms of movers, you have a handful of stocks that are looking okay in the broader market universe. Stocks like Eicher Motors post earnings is up 8%. You've got Suzlon that's looking good. Wealth management, so capital market plays a good trade today. You've also got movement in insurance and asset management companies. A quick check on Swiggy. It listed on the exchanges yesterday. And what a day. It was the star of trade yesterday. Despite a very weak market sentiment, Swiggy did okay with a 16% rally in trade. This morning, though, quiet, but not, of course, selling off or falling off.
Okay, well, there you have it. That's the market right now. But before we get into the futures and options space, let's get in another conversation going on with Just Engineering. We have the earnings come through, and we have with us Pratik Patel. He's the chairman and managing director at Just Engineering, who joins us on the show. Pratik, good morning, and thanks for taking the time out. What I'm looking at is very, very strong numbers for at least your top line and the bottom line for the quarter gone by. Can you tell us about all the factors that have worked in your favor in this quarter?
Well, we had predicted this type of numbers. Our order booking is strong. Our focus is on export, and it's because of growing exports, our performance is improving quarter by quarter.
In that case, can you tell us a little bit more about your order book? Where does it stand? What is the number right now? And how much of this order book are you expecting to execute in the balance of this financial year?
So we have presently an order book of close to 850 crores. And we have projected revenues this year of 675 crores. So our order book covers the current projections easily, and by the end of the year we hope to start the new year with a strong order book of close to 900 crores, so that we can meet our revenue targets of next year, which would be around 800 crores.
And Pratik, you mentioned that you guys are focusing on the markets abroad. So how much of this order book would be from countries beyond India?
And this out of India.
Yes, outside India.
60%.
Okay.
About 60% is outside India.
Also, Pratik, we've seen a considerable expansion in your EBITDA margins. In general, can you give us an overall picture on what you're expecting your margins to stand through for the entire financial year?
Well, EBITDA margins somewhere between 21 to 23% and PAT margins between 12 to 13% on yearly basis.
All right. And in terms of the kind of quality of, or rather the kind of projects that you guys are now signing up, can you tell us about what is in the pipeline right now? Because from what I understand is that you're focusing with respect to, or your focus is with respect to equipment around water and wastewater industry. Can you give us a little bit more color in terms of what kind of projects that you guys are seeing now?
See, worldwide, you must have been reading a lot of flooding is taking place everywhere. And as a result of that, new projects are coming up addressing concern about flooding. Presently, we are doing a big project in Kansas to isolate the railway infrastructure of Kansas from flooding from the river. Similarly, we are doing a big project in Hong Kong. So more and more projects now we are seeing which are addressing the issue of flooding. In future, seawater rising levels also is going to be a very big issue worldwide, and countries would have to invest huge sum of money in isolating their cities from rising seawater levels. So these are the two things, flooding and seawater is two things which is going to aid our growth in future.
And this is the kind of conversations that you're having with your clients as well in terms of future projects?
Exactly.
Okay. So from what I'm reading is that you do deal with major products when it comes to water control gates as well as screening equipment, among others. Is this going to be the focus for the business going forward as well?
Yeah, water control gates is our main product along with screens. But we are also expanding into other product lines which we are now rolling out internationally, like knife gate valves and other special products which we have. So eventually these two products will be supplemented by two more products so that we can have a robust export driven business.
Right. Pratik, can you give us an idea on the kind of cash flows that you had expected to generate towards the end of the year? That's the first part of my question. The second part is capital expenditure that you have in place for FY25. And well, going forward, if you are seeking an expansion in your capacities as well.
Inaugurating or commissioning two plants in 25, one plant in Chennai and one plant in Pithampur. We would also be expanding our facility in US. And for all this expansion, we do not need significant amount of loans. We would be able to meet major expansion by our internal accruals.
And what is your current debt level on a net basis?
Our current debt level must be less than 100 crores.
And you're comfortable with that level at the moment? There shouldn't be
We
a
are
problem.
quite comfortable with that.
Okay, Pratik, we leave it at that. Thank you so much for joining us and giving us more clarity with respect to the business going forward. Wish you the best.
Thank you.
So there you have it. That's the management of Just Engineering. A significantly strong quarter coming through for the company. And of course, as you can see, even on an intraday basis, it's advanced by around a good 8% for now. But we put the spotlight back on the futures and options space. And we now have with us Amit Bhuptani of Nirmal Bang Securities and Nilesh Jain of Centrum Broking, who joins us on the show right now. Good morning to both of you. Thanks for joining in. Nilesh, I'll start with you on the clear and obvious question of whether or not the correction is done for now. What is your opinion?
Morning, Adam. So it's too early to call it as a bottom, but I think there has to be some pullback, or I would say a dead cat bounce, which is due since a long time. I think we have a reason for that as well. Nifty has taken support at its 200-day moving average. Exactly at those levels, Nifty is witnessing some amount of pullback today. So looking at the overall setup, I think there has to be a follow-up move towards 23,700 to 23,800. Today being a weekly expiry, a high possibility of a short covering rally. If Nifty sustains about 23,600, then we might see the levels of 23,700 as well. So for the day, from an expiry point of view, the range looks like 23,500 to 23,700. That can be a broader 200-point trading range. Even if you look at the volatility index in the weeks, which is falling roughly around 2% today, and it is approaching towards the comfort zone. Below 15, if at all it slips, then we might see a follow-up move in the index. So overall, setup looks positive for the day.
So got Amit joining in. Amit, what are your thoughts on the index? We found a little bit of a floor for the last 1 hour. Do we have a trading strategy? Do you feel like the selling is done for now at least?
Good morning. Overall, if you look at the overall scenario in the last week session also, as we recommended that till the time Nifty is not going about 24,500, till that point of time, we should not create any new long position. And after that, we have seen major sell-off in the market. The current, as per if you look at the Fibonacci retracement level, the support for the Nifty was at 23,700 level. And in yesterday's session, Nifty gave closing below that level. Currently, Nifty is facing 200 DMA support at 23,500 level. So due to that, we are seeing some bounce back in the market, but overall scenario seems to be on the cautious front, and I'm expecting more selling can be witnessed in coming days of trading session. Below 23,700 directly, the retracement level comes near 23,300 to 22,800 level. So anytime Nifty goes below 23,500 level on the stable zone, we expect next leg of selling will be witnessed in the market. If any approach is coming in the market on the buying front on upside level toward 23,700, 750 level, I will recommend to sell on rise strategy in the market, because current situation, if you look at the overall sector like Nifty Pharma, Nifty Auto, Nifty Bank, on Nifty IT, all seems to be on negative front. IT is little bit of supporting right now, but overall major indexes we are seeing on the negative trend, and we are expecting more selling can be witnessed in coming days of trading session. So once if Nifty goes below 23,500 level on the stable zone, after that we expect more selling will be seen toward 23,300 level.
All right, so there you have it. Those are the views coming in when it comes to, well, your key benchmarks. I'm going to pull up the list of stocks which are seeing a change in open interest today in their respective futures. Do want to remind our viewers once again that we're going to have 45 new entrants in the F&O space come 29th of November. So, well, we're going to have a lot more tables in the casino available for placing bets as far as, I would say at least our traders are concerned. But overall, I'm talking about just today, we have, PI Industries, Dalmia Bharat and Manappuram Finance looking at shorts coming in, Eicher Motors and Ipca Laboratories looking at longs. And among stocks which are seeing unwinding, do we have significant amount of unwinding? Do we have short covering? Let's pull that list up as well. All five top losers in terms of open interest are towards short covering. So GNFC, Sun TV, Samvardhan all stand out in trade. A lot of lists, rather a lot of names on that list, and some very prominent ones too. You know, something like an Avenue Supermart, something like a Zomato, PB Fintech, even something like a Nykaa. They're all going to enter the futures and options space. Will come December, which probably could see active trading return, and of course a whole host of Adani Group companies too coming through. So we'll be watching out for that. But let's talk about, well, you know, all the stocks which are on our experts' radar. So, Amit, back to you on stocks that you like this morning.
My first recommendation will be from the IT front. As I have said, that the overall major index seems to be the negative front. But if you look at the overall setup, Nifty Realty we are seeing that is having support at 920 level, and I am expecting some bounce back from the realty front towards 975 to 1000 level on the index front. So my first recommendation will be from realty front will be DLF. In DLF we are seeing that the counter has seen some major setbacks in the recent days of trading session, and we are seeing that the counter has taken the monthly support, and I am expecting some bounce back in the counter towards 780 to 785 levels in coming day of trading session or next in 1 to 2 days of trading session. So new long can be created in DLF with the target of 778 with the stop loss of 760. And my second recommendation will be Laurus Lab. If we look at the overall setup on the Laurus Lab, the fall which have came in the market in last 1 month of trading session, we have seen that Laurus Lab is not much that affected in this fall, and I'm expecting some pullback in discount, as we are seeing that the stock is continuously taking the support of 50 DMA level, and with that support I will recommend new long position in the Laurus Lab for the target of 494 and with the stop loss of 478 level. My both the recommendation are buy front, because till that time Nifty is not going below 23,500 level. After till that point of time we will take some opportunity for the pullback layer targets in the market.
That's the view coming from Amit. Nilesh, what about you? What is it that you're constructive on? Any trading strategies and ideas for our viewers?
Absolutely, Samina. So I have two recommendations. First of all, if you look at the consumption space as a whole, we have seen a decent correction. I think more sort of correction seems to be over. Now it's time to pick up the quality stock. So United Spirit, this particular stock is looking attractive at current level. After a recent correction, it seems like it is forming a nice base formation. And today we are also witnessing some bit of build up on the long side as well. So United Spirit, one can go long, keeping a stop loss below 1422, and target on the upside would be 1500. And another stock that is on my recommendation list is again on the long side is the Indian Hotel. So if you look at this particular stock, the structure is looking very strong. In spite of the weakness in the market, this particular stock did not participate, and it looks like it is heading towards a new record high from here. So Indian Hotel futures can be bought, keeping a stop loss below 718, and target would be 765.
Right, we've also got queries now coming in from our viewers. So Shankar from Chennai writes in, and he's holding NTPC 390 calls at a premium of 12. Amit, you want to have a go at this? What do you recommend he should do? Let's take a look at how the 390 calls of NTPC are doing as we see. Shankar, of course, has them at 12, so it's deeply out of the money. Amit, any recommendations here? Would you recommend holding? Would you recommend cutting your losses as much as you can and running away in some ways?
Should hold the long positions, as we have seen that the major nervousness has been seen in the counter, and the stock is almost trading near 200 DMA support of 374. So if now it goes below 374 level on the stock specific front, after that only we will see second leg of selling. Till that point of time we might witness some sort of pullback in the counter towards the 385 390 level. At that point of time we can initiate a exit position in the NTPC. Currently the option is trading at 3.7. Once this option comes near 6.5 to 7 level, at that point of time we should create an exit position.
Okay, well, we move on and take the next query which is on our radar, and this one is on PNB. I will take this up with Nilesh. So Amjad from Mumbai says that he has the Punjab National Bank 95 call and he's paid a premium of 5. What's the outlook here? That's what he wants to know. So let's pull up the particular option. There you have it. So PNB firstly has gone in the money, And naturally, this also means that Amjad is sitting on a little bit of a profit right now because he's paid a premium of 5 and the premium now stands at 7.55. Nilesh, what's your view here? Should he book profit here or should he hold on?
Well, Agam, looking at today's reversal candle, I think that there will be a follow-up move in this particular stock, but the upside again might get arrested somewhere around 104. So I don't see any major up move, but yes, we can see a pullback towards 104. So first of all, I would advise to keep a stick stop loss below 7 rupees. The option is currently trading around 7.55. So in order to protect the gain, I would advise to keep a stop loss, stick stop loss. And on the upside, we might see a pullback towards 8, 8.5. I think that could be a good exit point. So overall, in the PSU banks, today is a good day of reversal. We might see a follow-up move, and to play that pullback, one can stay put.
The query coming from Dia, who writes in from Hyderabad. Dia is holding Sun Pharma 1800 calls at a premium of 29. Let's quickly take a look at DV's Sun Pharma and then see what the calls are doing. Actually, not too bad. It is out of the money and it seems like it's at 15.90 from the look of it. Today doesn't seem to be too bad a day. Nilesh, you want to have a go at this one? What does one do with Sun Pharma calls of 1800?
Well, I mean, the structure is not looking that promising, and given the kind of structure we have seen in the Nifty Pharma Index, it looks like it is heading towards 21,500 to 21,200 kind of levels on the lower side. So Sun Pharma being one of the heavyweight here as well, we might see a follow-up move on the lower side towards 1750 as well. But if somebody has already bought the call option, I think one should keep a stick stop loss below 13. And currently the option is trading somewhere around 16 rupees, and today it made a low of 13. So that should be the stop loss. And if at all we see any pullback in this particular counter, then we might see this option moving towards 22 to 25. That could be a good exit point.
Okay, but we move on and talk about Sun Pharma then. Actually, we've spoken about Sun Pharma, so I'm going to actually take a handful of other counters which are on our radar this morning. And of course, while we see a little bit of recovery coming through, there are plenty of other counters which are actually in focus. Well, one of them being Apollo Tyres. What we are actually seeing here as well is an interesting bullish candle of sorts, if I can call it that. I reckon the experts we have on a panel will be more suited to make a comment on here. But Nilesh, look at Apollo Tyres, and I'm looking at the futures here. It does seem like today's low is lower than yesterday's, and today's high is higher than yesterday's. Does this mean we can expect more strength in Apollo Tyres here on?
Absolutely. Agam, if you see the structure, technically this formation is called as a bullish engulfing candlestick formation, which is considered as a bullish reversal pattern. So looking at today's bullish candle, also we have seen higher than average volume so far in this particular stock. And even if you look at the derivative data, we are witnessing a build-up on the long side as well. So multiple, cluster of indication here that this stock is poised for a rally towards 490 to 500. And on the lower side, today's low seems to have formed a multi-month low, and it's acting as a strong support as well. So yes, one can go long on dips, and upside target would be somewhere around 490 to 500.
Just very quickly, Amit, while we still have you on the show, a couple of stocks that have been attempting a little bit of a recovery. Asian Paints, Trent is what I'm going to ask you about, because both of them yesterday were looking okay, but by the time we shut shop, they probably were the better off counters in terms of losses. But today they're failing any sort of a material recovery. Would you trade either of these counters?
I think we should wait and watch. Totally, if you look at the Asian Paint, it has created a doji pattern on the daily chart, and once if it goes below 2460 level again, we will see the selling pressure will be continued while going ahead. If you look at the trend is trading at a support level, and we might witness some next 2 to 3 days of trading session in trend. We might see some consolidation phase. Support for the counter is at 6320, and upside the fresh breakout will take place at 6650 level. Once if the counter goes below above 6650 level, then only we might witness some sort of buying opportunity in the counter. Till that point of time, we might expect the range bound momentum. So we should wait and watch for the trend. And in Asian Paint, once if it goes below 2460 level, new short need to be created.
Okay. there you have it. That's the view coming in on a whole lot of stocks when it comes to the futures and options space. And I'm going to thank both our experts for joining us, both Amit and Nilesh, and taking us through their views in the markets, giving us a handful of trading ideas, and of course solving a handful of viewer queries as well. But we now talk about commodities, and for that we are now in conversation with Ajay Kedia, Director at Kedia Advisory of Non-Agro, who joins us on the show. Good morning, Ajay. How are you looking at, well, trade pan out for the precious metals, gold and silver? They seem to have taken a little bit of a beating of late, but do you think recovery is on the anvil, or do you think there could be more selling coming through?
Very good, man. Definitely, I think in last 10-12 days, we have seen a great erosion, as I was being slightly skeptical. After the election and this Fed meet, we were expecting a correction, and correction was supposed to be end around 75,000. So I think this is a last leg of weakness, and we may see some consolidation. No doubt PPI numbers and other Fed members speech would be important for today and tomorrow, which can give some support. But as of now, technically market has been under pressure. Still, we expect ground should be near to 73,600 for gold, and silver might test 87,200, 87,500. But I think this is a last leg for weakness for bullion, because dollar index has overstretched its rally. So I think some kind of profit booking would be seen as we end till Friday, but as of now, it's slightly under pressure only.
Okay, let's talk about crude then. Ajay, what are you doing with this one?
With the Donald Trump policy of American first, we know that a longer period, definitely there will be a good supply, or we can say non-OPEC supply would be rising. But as of now, I think prices are very well holding $70 mark for Brent. So unless until this level doesn't break, market seems to be trading in a very choppy range. Looking to that only, we expect 57.20 is a good level to buy, with a 56.40 as a stop loss, 58.50 as a target. So I think a range-bound activity would be there for crude oil as of now.
And same for natural gas, Ajay, or do you think there's a contrary view here?
See, I think natural gas has already rallied. We generally see whenever there is a hurricane, generally the demand drops, and then all of a sudden supply side concerns comes, and that is why we have seen a great rally of almost 9 to 10% in last 3-4 sessions. Right now, we expect 250, 252 will be acting as a strong resistance. And looking to the evening inventory storage data, which is showing a little bit built up, we may see a technical profit booking could possible in natural gas for a target of 240 to 244. One can take a intraday shot.
You know, Ajay, you did talk about gold, but I think we also need a view on silver, because that's the other very, very active precious metal that came through, but it does seem like this one is also under pressure. So are you also bearish on this one?
Not so much bearish, because still the gold silver ratio suggests silver will be outperforming. Take an example of yesterday, where we have seen a 0.25% fall in gold, but silver was slightly down. No doubt some pressure has been there because of weakness in base metal due to Chinese demand concern. But I think small weakness could be possible to the level of $30 in international and 87,200, 87,500 for domestic side. But it should be a long-term buy opportunity at this current level.
And base metals, Ajay, anything that stands out for you here?
See, I think base metal is totally dependent on the Chinese news, and we have seen in last 3-4 months, China market is continuously under pressure despite of stimulus update and all. I think as of now, nothing has been supportive. No doubt, some more technical pullback can be there for copper, could be 787, 788 as a immediate support. Whereas zinc and aluminum also facing some kind of pressure, where target could be 272 for zinc, and aluminum could be 232. But be cautious, because tomorrow morning market will be on holiday mode on domestic market, whereas evening market might be more crucial because of key data point which will be releasing today from US side.
Okay. All right. So, well, Ajay, we leave it at that. Thank you for joining us and taking us through your views on those very actively traded commodities. We've actually spoken about a whole entire gamut of commodities out there, including being, well, slightly negative, at least with the negative bias when it comes to precious metals like gold and silver specifically. But on the other hand, we're also likely to see some gains coming through when it comes to, well, crude going forward. And of course, notwithstanding the kind of pressure that OPEC could bring. But let's shift focus back to the markets and equity markets by that I mean. So we've actually seen the Nifty give up a lot of the gains, a lot of the early morning gains to a certain extent. And the Bank Nifty, again, hanging at around 50,000. We've actually also seen the Bank Nifty come off. In fact, if I'm not mistaken, after the open at the trading at the lowest point in the day. And this is always going to be a challenge when it comes to markets, because especially when you have a fall and a sharper fall as we have seen, the selling is always going to come through at lower levels. But we'll continue to give you an update on these. For now, it's a wrap on this edition of the FNO show. But on the other side, we get you the small and the mid cap show. Stay tuned in and we'll be back in just a bit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Welcome to the Small and Mid Cap Show. I'm Hiral Dadia, and with me is Anushi Vakharia. Anushi, good morning.
Hey, good
Clearly,
morning.
if you see in terms of markets in today's session, a good bounce back from the kind of downtick that we saw in the last hour of trade yesterday. If you see in terms of Nifty 50 as well, pretty much flat now. Seems that we are again going back into the red, but we continue to stay below the 23,600 mark in today's session as well. Let's quickly pull up Bank Nifty because that is where the pain is also continued. 0.1% higher. Again, some bit of cooling off that is happening with regards to Bank Nifty as well. You have the mid cap and the small cap index, which interestingly is in the positive. However, the pain continues for FMCG counters. 0.8% higher in mid cap, on mid cap 150. And if you see in terms of small cap 250, almost 1% higher. Let's quickly look at the top gainers as well as the top losers. From a sectoral perspective, you had the real estate pack, which was the top losing sector yesterday. Today, if you see in terms of the heat map, that's bounced back into the positive. Media is up in trade. You have FMCG, which is the top losing sector. Oil and gas continues to bleed. IT continues to bleed as well. If you have a heat map of Nifty 50 counters, let's see where the action is in today's day of trade. Overall, if you see in terms of Nifty 50 as well, SBI Life, Kotak Mahindra Bank, iShares, these are a few of the names. Reliance Industries is again in the positive. So there is a possibility that everyone is talking about that there will be a bounce back in terms of Reliance Industries that could last from here on. BPCL trading under pressure as well. If you see in terms of broader markets, let's quickly look at a few of the names. If you can give me a heat map in terms of BSE 500, that will be interesting to watch out for, because there are stocks which could be giving you numbers. There you go. PI Industries down under pressure. SKF, AstraZeneca, Uflex, we will be getting the management as well, all under pressure. Mishra Dhatu is seeing some good gains, and this is on the back of numbers. Suzlon continues the up move. DCM, Shriram, Paytm and Nosil. These are a few of the top gainers as well. Very lastly, a few other names I want to highlight. Newland Laboratories, 7.5 to 8% up move. That has continued. You have, I think it's Dishman Carbogenics. Again, this stock is up in trade as well on the back of the CRAM segment. So 15 to 16% is the kind of up move that we are seeing on this counter. And very lastly, if you see on the losing streak, PI Industries, SKF India, AstraZeneca Pharma, second consecutive session of declines on the back of a weak set of numbers is what we are seeing. So that's what the market picture is looking like. But Patel Engineering, that's a stock that we are focusing on as the first management today. Let's quickly pull up the stock on the screens and see what the counter is doing in trade. Because if you see in terms of the numbers, clearly a strong set is what we've seen. 3.5% is the kind of up move in today's day of trade. Overall, the revenue growth is higher than the guidance of around almost 10%. Margins are in line with what was guided so far. Let's welcome in Kavita Shirvaikar, MD at Patel Engineering. Kavita, firstly, congratulations for the strong set of numbers that we've already seen. If you could help us understand, one, the revenue growth has been higher than what you had guided for. Margins are in line with the 14% guidance as well. Is this something that you think will be continued in the second half of the year, or do you think you will outperform these numbers as well?
Hi. First of all, thank you very much. See, let me tell you, we are on track on execution. As you have seen, our revenue growth is 15% for the quarter. Our guidance was 12%. So let me tell you, we will be continue to, on track. One example, like Subansiri project, the value is around 1,500 crore. We have executed around 1,500 crore work in 4 years. So let me tell you, we have a strong team of execution and we are on track.
Hi Kavita, this is Anushri joining in. So firstly, you mentioned that 10% was what the guidance was for this year. Now, if we move forward to the next year, it's about 15 to 20%. Want to understand from you, what are the key growth drivers that you're looking at for which you're aiming for this higher revenue growth? And while the FY25 margins is at 14%, do you see a further uptick in this number?
See, let me tell you, what are the growth drivers? As you know, we have a strong order book of 17,000 crore. 64% coming from hydro sector and around 20% from irrigation sector, where we are the pioneer. Like we have completed 87 dams. We are the pioneer of micro tunneling. So all put together, execution at the ground level, strong execution team, and our vision. So that is the growth drivers for us. And over and above, as you know, we are consistently reducing the debt. Our debt last March, it was 2,000 crore. Now it has come down to 1,500 crore, almost all about. So we are continuously monetizing non-core asset and focusing on our core sector. So going forward also, we are fairly confident to maintain the growth and margin at the same level.
Kavita, a follow-up that I have on this is you mentioned about the debt reduction. What's the plan from here on? We are at almost 1,438 crores. Where would it be by FY25? And what's the target in terms of next year as well? And what is the monetization plan from here on, taking into consideration that you've already monetized around 330 crores worth of your non-core assets?
So this year our plan was around 150 to 200 crore, but we have already achieved around 330 crores. Next half also we are expecting to around 100 to 150 crore. And next year onwards, we are saying ki we will be, though we are targeting 15 to 20% growth year on year, but we will be able to maintain the debt level at the current level. Like our interest cost will not go up, but our revenue and margin will go up. So absolutely our net profit will increase.
Okay, so the debt levels will stay at similar levels as that. Is that what you're implying?
Yeah.
Okay.
Overall, over and above growth, our debt will remain at the same level.
All right, and now coming to the order book, now you've mentioned about your order book which stood at about 17,000 crore. I want to understand, of this 17,000 crore, how much do you plan to execute in this next half itself, and what is the kind of pipeline that you're currently looking at?
See, we have, first half, we have already achieved 2,200 crore. Our target for this year is 10% growth over last year. So balance also, we see around 2,500 crore next 2 quarters we are expecting to achieve. And next year, our target is to 15% year on year.
Okay.
And as regards order book, we have already started submitting the bids because projects, as expected last year, because of election year, order book was subdued. Now, post Q2, orders started coming for bidding. Bids are under evaluation already under 10,000 crore. And over and above, we have shortlisted around 40,000 crore of worth of projects which will be bidding in near future. So we are targeting in next year from now onwards around 10,000 crore, considering our ratio 20%. So around 10 to 12,000 crore order book we are targeting in next 1 year.
Okay. Taking the order book that you are targeting into consideration, would you still maintain your growth guidance of 15 to 20%, or do you think you will be able to surpass that? And an added question to that is, what are the kind of high value projects that you're expected to take to expand your portfolio?
See, let me tell you, hydro, there is huge opportunity available, and overall the single size of the project itself is like 10,000, 15,000, 20,000 crore. So let me tell you, we have signed MOU with RVNL and IRCON, to such large bid for such large value projects, which will give us, another milestone going forward. Now, as regards target 15 to 20%, it is on a concern. We are fairly confident we will be able to maintain that target.
Kavita, I want to come back to the pump storage projects more. I want to understand what is the current opportunities that we are looking at in this space, because this is an area where a lot of development is happening. 60 gigawatts is under survey, as you've mentioned. Want to understand what is Patel Engineering's role going to be in this, and of this 15 to 20%, I understand that this is a huge contributor to your business. Have the bids already started for this, or it's after the next 1 to 2 years that there would be a ramp up that we'll seeing the order inflows from this side?
So as you rightly say, government focus is on pump storage. Last budget also we have seen there is huge focus on pump storage projects. So like 60 gigawatt, which is under survey and investigation, let me tell you, some of the projects already started coming for bidding, and which I said around 10,000 crore, which bids under evaluation. Out of that, pump storage also we have started targeting. We have started bidding for the projects. So our target, let me tell you, currently around 4 to 5 projects under execution. We are already doing 1 project for the government. So we are quite hopeful and target around we will continue to maintain our share of revenue.
Considering the pump storage projects that you've mentioned, another one I wanted to mention, what is our capex plans going to be? Because if you look at in the first half and compare it with the last 3 years, the capex was comparatively softer. So are we looking to ramp up our capex for the next half, and for even if you can give us an outlook on the next 2 to 3 years, what the capex number is going to be?
See, capex is based on the new order book. On an average, around 100 to 150 crore addition every year we make to the capex. Now, currently, as I mentioned, that last year, because of election, order book was subdued. First half, capex is looking at the lower side. But as I mentioned, going forward, we are targeting around 10,000 crore of work in next 1 year. Accordingly, capex also will from Q2, Q3 onwards, and next year it will be in the same range.
From the hydropower space and the 10,000, 12,000 crore of opportunities that you're looking at, another kind of an update which was there from NHPC. You've been declared as the lowest bidder for this 240 crore of project. What is the development happening here? What's the progress here? When do you plan to add this to your order book? If you can give more clarity on this one.
See, we are L1 into 40 crore work project. We are expecting LOA to come shortly. The project duration is 18 months and we are fairly confident we'll be able to complete within given timeline.
Coming to this, I wanted to again emphasize on the margins. Now, if you can just give us a breakup, like if hydro is your biggest segment, but there are other segments also that you have. If you can give us a margin profile, do the margin profiles differ across the various segments that you have? If you can just give us a breakup on what is the kind of revenue mix that you're targeting and the margins of these segments that you have currently.
See, as you know, our majority order book is coming from the hydro. So hydro, there is a margin of 1 or 2% higher than other sector, and irrigation is 1 or 2% lower than the normal margin. So on an average, we are saying we'll be able to maintain the margin of 13 to 14%.
So 13 to 14% is the margin that we are looking for this year. Now, if you look at your overall project mix also, if we take the first half in consideration, H1 was kind of muted on the government side due to the elections which have taken place. What is the kind of update that we are looking at from the government side and even if the private side? How is the kind of orders that are taking place right now? Are we seeing a pickup happening from the next half onwards? If you can give us more clarity on that.